Let's jump right into this because we are looking at a massive, seismic shift in the global economic order. We're talking about a fundamental fracturing of transatlantic trade that officially kicks off on May 1st, 2026. Now, this isn't just some distant geopolitical headline that you can safely ignore. No, this is a structural market shock that's going to directly impact the actual numbers you see when you log into your brokerage account. In this explainer, we're doing a deep dive into the absolute reality of this 250 billion euro tariff wall. We'll look at how it's going to rip right through the automotive sector, and most importantly, we are going to break down the highly technical, precise derivative strategies that institutional wealth managers are already using to hedge against all this unprecedented volatility.
Right off the bat, there is a brutal reality we all have to confront today. A 25% tax on German cars isn't just a Mercedes problem. It's a currency contagion waiting to hit your brokerage account. It's incredibly easy to look at international trade friction and just assume it's totally isolated to foreign manufacturing. But the blast radius of these tariffs, it is absolutely massive. We are moving out of a temporary stabilization period and right into an era of fierce regulatory warfare. And listen, if you're sitting there thinking a purely domestic portfolio keeps you insulated from this kind of shock, we really need to look at the underlying math.
Okay, so here's our roadmap for today. 1. The 250 billion euro tariff wall. 2. The 25% automotive math. 3. S&P 500 contagion. 4. Currency inversion. And 5. Derivative hedging.
Section 1. The 250 billion euro tariff wall. So, the primary catalyst hits on May 1, 2026. This is when the U.S. administration unilaterally slaps a 25% tariff on all passenger vehicles and light trucks coming in from the European Union. Now, legally and geopolitically, they're executing this maneuver under Section 232 of the Trade Expansion Act, and that is a really crucial detail to grasp. Section 232 allows for tariffs based entirely on national security considerations. So by officially labeling European automotive imports as an actual threat to the U.S. industrial base, the administration is able to completely bypass standard trade restrictions and WTO norms. It's wild. This officially marks the end of the 2025 Turnberry Agreement. We are now operating in a high volatility regime of regulatory warfare, and the markets literally have to reprice that reality overnight.
Moving on to Section 2, the 25% automotive math. To really understand the massive macro impact here, we just have to look at the micro reality for a normal, everyday consumer. Imagine a BMW model that normally retails at $50,000. Suddenly gets hit with this massive duty. If that full 25% tariff gets passed directly to the American buyer, the cost of that exact same car skyrockets to $62,500. I mean, a consumer doesn't just cheerfully accept a $12,500 markup overnight, right? They change their behavior completely. They either downsize, they delay the purchase, or they just walk out of the dealership altogether. That kind of premium shock entirely breaks historical purchasing behavior, and that's exactly where the quantitative models start flashing bright red.
Now, what's really interesting is how institutional analysts map this out mathematically. They use this concept called price elasticity. The average price elasticity for European auto imports is negative 1.4. In plain English, that just means for every 1% increase in the final retail price, the actual quantity that U.S. consumers buy drops by 1.4%. So, if we look at a baseline shift causing a 22.5 percentage point net price premium increase, and we multiply that by our negative 1.4 elasticity, we arrive at a pretty catastrophic mathematical certainty. We're looking at a 31.5% total volume collapse. In absolute financial terms, that contraction violently strips 15.1 billion euros annually straight out of European auto exports to the U.S.
But, not all manufacturers carry the exact same level of risk. We're dealing with deeply segmented vulnerabilities here. For instance, Stellantis carries a staggering 40% U.S. revenue exposure, though with a pretty heavy domestic focus. Compare that to BMW Group, which sits at 26% exposure. Now, you might be thinking, well, BMW has that massive plant in Spartanburg, South Carolina. They must be insulated, right? Actually, scratch that, because here is the real shocker. The administration also targeted automotive components under Section 232. Tariffs on vehicle parts alone can drive up the cost of a U.S.-assembled European car by up to $4,000 per unit. So even localized domestic production is going to face severe margin compression. Honestly, there's literally nowhere to hide.
Let's dive into Section 3, the S&P 500 contagion.
There is this very common and honestly very dangerous assumption floating around that simply adopting a Buy American strategy is a totally sufficient hedge against this whole trade war. The data absolutely shatters that illusion. The titans of American industry are standing right on the front lines, deeply integrated, and fully exposed to the fallout. I mean, look at Apple. They derive 44% of their revenue from non-US markets. Amazon is sitting at 57%. Philip Morris is essentially at 100%. These massive U.S. corporate giants rely heavily on the European economy. They are incredibly sensitive to international trade friction, which basically means if you hold a supposedly safe domestic portfolio, you are inadvertently carrying massive, unhedged European risk.
And obviously, the counterattack from the European Union is incredibly strategic. They aren't just going to blindly tax American cars in response. Instead, they're running a highly calculated, asymmetric campaign of political warfare. They've actually prepared a retaliatory list covering up to 95 billion euros of U.S. goods, and it's specifically designed to maximize electoral fallout in key U.S. states. Think about it, tactically targeting American bourbon exports to put massive pressure on key senators in Kentucky, or heavily taxing motorcycles to hit manufacturing hubs in the Midwest. This squeezes the margins of U.S. multinationals and triggers a negative macro-financial feedback loop that degrades S&P 500 earnings right under the nose of the passive index investor.
All right, Section 4, Currency Inversion and Risk.
So historically speaking, the US dollar has always been the ultimate safe haven. Whenever global stress hits, capital floods straight into the dollar and its value goes up. But the reality of 2026 presents a profound, almost scary departure from that norm. There's a direct correlation between euro to dollar volatility and these manufacturing margins. As isolationist trade policies start severing the link between the dollar's value and global market prices, the dollar actually loses its historical safety premium. This leads to what's called a safe haven inversion. The end result? A sharp 12% depreciation of the US dollar against the euro. If your brokerage account is denominated in US dollars, this 12% drop acts as a massive silent tax on your purchasing power. It's like a chunk of your wealth just vanishes into thin air.
And this intense currency volatility, it's all happening against a backdrop of what industry experts at Lazard and Roland Berger are calling stagflation. It's a great term. Imagine trying to completely rebuild the foundation of your house right after your paycheck has been cut in half. That is stagflation. It's a structural decline defined by a toxic mix of stagnant production combined with forced fundamental transformation. European automotive suppliers are caught smack in the middle of this mess. Their profit margins have already plummeted to an incredibly thin average of just 4.7%. The tariff wall acts as an absolute accelerant here, forcing these companies to execute massive, incredibly expensive reallocations of capital just to survive the transition.
Which brings us to Section 5, the alpha, derivative hedging.
So the crucial point is, how do the professionals actually navigate this? Because traditional buy and hold strategies, they simply fail during periods of stagflation. Instead, institutional managers are turning to VGK, that's the Vanguard FTSE Europe ETF, as their absolute premier proxy for hedging European exposure. And it's a real game changer that an instrument this efficient exists for this exact problem. It has a tiny 0.06% expense ratio, which makes it highly cost-effective for massive institutional hedges. It's got a heavy sector concentration in financials and industrials, which are the exact sectors bleeding the most from this trade war, and above all, it is highly liquid, which is literally an absolute necessity if you want to execute the dynamic option strategies we are about to break down.
Okay, so the most foundational Wall Street strategy here is the protective put. Honestly, you can think of a protective put exactly like homeowners insurance. A put option gives you the right, but not the obligation, to sell an asset at a predetermined strike price. In Step 1, an investor holds their underlying equity exposure. In Step 2, they buy a VGK put option with a strike price that acts as a hard floor beneath their portfolio. If the trade war causes a total market meltdown, if the house burns down, so to speak, the value of the underlying portfolio drops, for sure, but the value of that put option skyrockets, completely offsetting those losses. And Step 3 is the magic of it. The absolute maximum amount you can ever lose is just the cost of the insurance policy itself, the premium you paid.
Now, Strategy 2 takes that concept even further. It's called the collar. Wealth managers obsess over this for capital preservation because you can often execute it at a near zero net cost. Step 1 is exactly the same. You buy that protective put. But, as we know, options cost money. So in Step 2, you simultaneously sell a covered call option. By selling that call, you collect a premium, and you use that incoming cash to completely pay for the put you just bought. You are essentially selling someone else your extreme upside to perfectly fund your disaster downside. Sure, you cap your maximum potential profit if the market unexpectedly rallies. But in exchange, you establish a rock-solid, hard floor on your losses without laying out significant extra capital out of pocket.
Strategy 3 is the bear put spread. Look, when panic hits the market, volatility spikes, and buying outright option premiums becomes incredibly, painfully expensive. To bypass that massive cost, institutional investors use spreads. In Step 1, you buy a put at a higher strike price to lock in your initial protection. But in Step 2, you simultaneously sell a put at a lower strike price. The premium you collect from selling that lower put directly offsets the massive cost of buying the higher put. The result in Step 3 is a drastically reduced premium outlay. Now, the trade-off here is that your downside protection is capped. It's only valid for moderate drops. If the market falls below that lower strike price, your protection maxes out. But in a high implied volatility environment, this cost reduction technique is an absolute essential.
Of course, successfully executing these hedges requires mastering the underlying mathematics of options, known on Wall Street as the Greeks. Institutional desks aren't just guessing out there. They are rigorously monitoring delta, which measures exactly how much the option price moves for every $1 the stock moves, and gamma, which measures how fast that delta is accelerating. Most importantly, they are constantly tracking vega, which measures implied volatility. The smartest money did not wait for these tariffs to be officially announced. They bought this insurance when vega was incredibly low and cheap, cashing in on the massive volatility expansion the absolute moment regulatory warfare became a reality and panic hit the broader market.
All of this leaves us with a final, really profound question to consider as you evaluate your own portfolio's exposure. Macro researchers indicate that there is a definitive breaking point here. If average tariffs and transatlantic trade barriers escalate and exceed a critical 26% threshold, will the entire international monetary system literally be forced to shift its anchor from the US dollar over to the euro? The era of blindly relying on the Buy American illusion is absolutely over. The 250 billion euro tariff wall has fundamentally altered the risk-reward profile of global finance forever. Thank you for joining me on this deep dive for this explainer. Stay focused, stay hedged, and keep analyzing the data.